Today, I have to confront some of my more painful holdings. Novo Nordisk, NVO, a company that leveraged a century of expertise in insulin to pioneer the largest weight loss drug era in human history with its revolutionary GLP-1 medications, Wegovy and Ozempic. From being the king of European stocks in 2024 to where we are now in 2026, NVO has undergone a brutal valuation reset. At a current PE ratio of 10 to 12 times, is this a value trap or a new starting point? Based on my internal valuation model, I have projected performance for 2026 to 2028. 1. The 3-year roadmap 2026, the deep squat period, most painful. Expected revenue, $33.0 billion to $35.5 billion. EPS, $2.80 to $3.10. This is the year of maximum friction for NVO. Institutional investors find the stock unappealing as the impact of U.S. Medicare price negotiations fully lands. To maintain market share in a cutthroat environment, the company has been forced into a proactive price reduction strategy. Financial profile. Both revenue and EPS see a year-over-year decline of 5 to 15%. Market sentiment. Valuation is slashed to the bone as crowded funds exit in a stampede. 2027. The scaled dividend period. Logic reversal. Expected revenue, $36.8 billion to $38.2 billion. EPS, $3.35 to $3.55. Volume overprice. Billions of dollars in past factory investments, including the integration of Catalent facilities, reach full production capacity. While margins per dose are thinner, explosive global volume growth offsets pricing pressure. The moat. GLP-1 drugs remain the core. NVO maintains a dominant market share of approximately 54 to 56%. 2028. The innovation explosion period, revaluation. Expected revenue, $41.0 billion to $43.5 billion. EPS, $3.90 to $4.25. The harvest season of the 3 to 5 year cycle and the critical moment for NVO's generational product shift. The new king, the next-gen compound. CagriSema enters its explosive revenue phase. With superior efficacy and fresh patent protection, profit margins re-expand. Channel penetration. Full rollout of high-dose oral Wegovy allows the drug to penetrate the broader mild to moderate obesity demographic. 2. Is it a value trap? A value trap is defined by permanent business decay. I revisited the risks of a permanent decline for NVO. The moat is still deep. Despite price cuts, gross margins remain above 80%. While Eli Lilly's Zebound/Mounjaro is growing rapidly in the U.S., Novo Nordisk maintains over half the global share thanks to an earlier global footprint. Demand is not shrinking. With an aging population, the market is expanding. The state of the business is simply shifting from hyper-profit to steady growth. Pipeline depth. CagriSema is the real game-changer over the next 1 to 3 years. It is more than just a weapon against Lilly. It is the key to resetting the patent cycle and reclaiming pricing power. 3. The dividend, the hardest floor. At current prices, NVO's dividend yield is nearing 5%. At a 10 times PE, the yield is now comparable to risk-free rates, providing a solid safety net. 4. The explosive potential. Valuation repair. Even if earnings only recover to a steady 5 to 8% growth rate, a recovery in market sentiment could see the valuation multiple re-rate from 10 times back to 20 times, the standard for a stable leading pharma giant. This valuation plus earnings double recovery, the Davis double, is the true source of alpha over the next 3 years. The worst-case scenarios. I am prepared for the possibility that NVO remains a trap. These risks include policy and pricing risk, the bleeding of profit margins. If IRA negotiations result in price cuts exceeding 40 to 50% without volume compensation, net profit could enter a multi-year plateau. Competitive erosion. If Eli Lilly's production capacity fully unlocks in 2026 and they use their slight efficacy advantage to trigger a price war, NVO could be stuck in a zero-sum game. R&D uncertainty. If CagriSema's Phase 3 data shows safety issues or fails to meet efficacy targets, NVO loses its holy grail for a turnaround. Operational risk. The aggressive acquisition of Catalent brings depreciation pressure and the risk of FDA warning letters. Any compliance-related shutdown during a price war would be a catastrophic blow to credibility. Summary. For my system, the expected return on Novo Nordisk, NVO, remains positive. I am prepared for the value trap outcome, and while the process is painful, I choose to stay the course.